The topic of passive income is huge right now, and it's a very popular and mainstream subject, and a lot of people make the dangerous mistake of assuming that just because passive income exists that it's easy to get. And over the last year, maybe 2 years, we have seen a monumental change in the financial markets, where the topic of investing and generating a residual income has for the first time ever become mainstream and become something which is popular with the masses. And one of the effects of this change in the market structure has meant that traditional sources of passive income, for example the stock market or real estate, have become overcrowded, and the yields have fallen to levels which aren't viable or even worthwhile for many investors. I mean, the S&P 500 is selling for a 2.5% yield, and real estate prices are unaffordable to most average people, meaning that if investors want to generate better returns than 2 or 3% per year, they have to think outside of the box, and they have to look at areas of the market which aren't fully mainstream, and one of those areas is crypto. And within the crypto market, one of the currencies that I use to generate a passive income is VET, the native currency of the VeChain platform. And my strategy in VET is very simple. I try to buy large amounts of VET during cyclical lows and hold indefinitely, allowing the effect of compounding to do its work, by selling my VeThor dividends to accumulate more VET. And when an investor owns VET, they effectively own a stake in the VeChain platform and therefore the subsequent income that it produces, through its operations by providing supply chain management services, which is what VeChain do in addition to a number of other things as well. And hey, if you're enjoying this video so far, I want to ask you to do me a small favor and subscribe to the channel to allow me to spend more time making videos like this. So anyway, right now the staking yield for VET is around 5% per year, and that's not a huge amount, but if we consider the 2.5% yield in the S&P 500, VET is around half the price of the S&P from an income-based perspective, meaning that the VET investor is getting twice the amount of residual passive income per dollar invested than the S&P investor. And what's more than this is that in my view at least, the likelihood of price appreciation in VET is substantially better and much higher than in the S&P. I mean, if we actually take a moment out to think about the fact that we are living in an ultra-liquid, zero-interest rate environment, where there is a huge oversupply of fiat money, and then we consider the increasing levels of money printing the world over, and then pair that with the fact that stock prices have more than quadrupled on average over the last decade, how much more can governments do to prop up the stock market bubble? How much more quantitative easing can we do before we experience hyperinflation? And how much lower can central banks artificially pull interest rates to try and kick the can a little further down the road, before the US dollar and the British pound become worth no more than monopoly money? And a lot of people think that the stock market index funds are very safe ways of investing money, which it can be over long periods of time, and they have been historically. But again, how much further can asset prices really rise? People are already accepting yields of 2.5%. And Tesla is selling for nearly 1,000 times its recorded income, representing a $1,000 average annual return per $1 million invested. Whereas on the other hand, blockchain-based technologies, for example crypto, do not rely upon centralized finance. In fact, they are the exact opposite. And strangely enough, the worse that the general economic condition becomes, the better off crypto, and the more that crypto grows. People are already switching over to using digital currencies in droves, abandoning centralized finance and government-issued currencies wherever possible. And so again, I think that price appreciation in VET is far more likely to occur over the next decade than in the S&P 500. But that's just my opinion, and maybe I'm wrong. All I know is that the prospects for growth are good, and that the platform is growing at a fairly substantial rate, meaning that there is a strong growth in the earning power of VET, and all of the major signs point toward a situation continuing on into the future, especially if we consider the pure illusion in the wider economy and the fact that there literally isn't much more that can be done to keep the equity bubble going on for much longer. As a long-term investor, I reinvest my VeThor proceeds to try and accumulate more VET over time, and with a staking yield of around 5% per year, I expect that 5% today will be worth a lot more than 5% over coming years. You could also use the VeThor proceeds to diversify into other cryptos or even other asset classes, but still, whichever option you choose, there is a compounding effect which can be achieved in VET. And the thing that I really like about the passive income from VET is that when I buy VET, I lock in at the purchase price, and as the platform is fast growing, within a few years, VET will likely be earning a lot more than when I bought it, but my cost basis remains the same. And of course it's a double win, because when the income producing power of an asset increases, its value increases as well, meaning that my portfolio's earning power and ability to generate passive income has grown very quickly over the last year, and so has the actual market value of the holding as well. Now it's important to remember that anything can happen in the crypto market, and that I'm sharing my own opinion and my own thoughts on the subject, but it's entirely possible that I may be wrong, so be sure to do your own research. Thanks for watching.